Stop scrolling. Because in the last few hours, the silver market just did something it is not supposed to do. COMEX open interest collapsed to multi-year lows, the paper crowd quietly vanished, and yet silver refused to break. It hovered under $90 like an invisible hand was holding the floor, and at the exact same time, the US Mint slapped a $173 price tag on one single ounce. That is not a premium. That is a confession. I'm John A.G., and you're watching Silver&Golden Signal Lab. Let's get into what just happened, why it matters, and why this might be the cleanest paper versus physical tell we've ever seen. Here's the headline in plain English. The paper market is pretending silver is normal, while the physical market is screaming that the metal is gone. Most people will miss this because they only watch the chart. They stare at the ticker like it's the truth. But the chart is just the last traded promise, not the last available ounce. And the promises are getting thinner by the day. Today's tape looked boring if you didn't know where to look. A little dip, a little bounce. Talking heads calling it healthy consolidation and rotation back into risk. That narrative is designed to sedate you, because what's happening under the surface is a structural decoupling, a ledger problem, a balance sheet problem. We sold what we don't have problem. Let me show you the first crack, the US. Mint is selling a 2225 1-ounce silver-proof coin for $173. The screen price is around $90. Do the math, and you get roughly a 92% gap, 92%. People will rush in and say, bro, it's a proof coin, it's collectible, it's a special finish. Sure, proofs have premiums, but not like this. For years, proof premiums were the polite tax collectors paid for shiny packaging and limited runs. They lived in the 20% to 40% zone, sometimes 50% in weird years. A 92% spread is not a collector premium, it's a replacement cost premium. It's the mint telling you, this is what it costs to get the silver, this is what it costs to keep the machine running. And if the mint is paying replacement cost while the COMEX is printing fantasy prices, you don't have a market. You have a split reality. Now here's the part that should make your stomach drop. Open interest fell under 150,000 contracts. Open interest is the number of outstanding futures bets, longs and shorts together. It's the size of the paper crowd still playing the game. When open interest collapses, price usually collapses with it. Because it means demand is leaving, the bid is fading, and the trade is dying. Except that's not what happened. Silver held the line. That tells you something critical. The exit isn't coming from the longs. It's coming from the shorts. It's the people who sold the promises backing away from the table. And if you've ever watched a Ponzi scheme wobble, you know the first sign isn't a fireworks headline. The first sign is silence. The first sign is the operators trying to reduce their exposure before the crowd shows up. They don't scream. They don't confess. They quietly buy back what they can. They quietly shrink the game, and they pray nobody notices. That's what this open interest collapse looks like to me. And the timing is everything. Because March is staring us in the face. March isn't just another month on the calendar. It's one of the big delivery months. It's when paper contracts either roll forward or they stand up and demand metal. Most futures contracts never touch a real ounce. They settle in cash. That's how the paper game survives. The system works because almost nobody asks for the seat they paid for. But the moment too many people stand for delivery, the theater runs out of chairs. Let's make this painfully simple. A standard silver futures contract represents 5,000 ounces. If open interest is around 150,000 contracts, that's 750 million ounces of paper claims. 750 million ounces. Now compare that to registered inventory, the deliverable silver sitting in COMEX vaults. It moves around, but it has been historically tight. Call it a few dozen million ounces. Even if you're generous, the ratio is ugly. This is why I say silver isn't trading like a commodity anymore. It's trading like an audit. It's trading like a stress test of trust. Because when you have 750 million ounces promised and only a fraction ready for delivery, you don't have price discovery. You have price control. And price control only works until it doesn't. This is the part where the mainstream commentators will try to distract you. They'll say, open interest is down, so the hype is dead. No. Open interest down can mean the casino is closing tables because the house realized the odds are changing. It can mean the shorts are backing off because they don't want to be trapped in the delivery window. Think about it. If you were short a market where physical premiums are exploding, where sovereign buyers may be accumulating quietly, and where industrial demand is rising, would you sit there smiling into March? Or would you cover while you still can? Exactly. Now zoom out for a second, because this isn't just about silver. Silver is the metal that exposes systems. Gold whispers. Silver screams. Gold is treated like a reserve, like a polite store of value. Silver is treated like a toy, until it isn't, because silver sits at the intersection of money and industry. It's both. That's what makes it dangerous for a debt-driven system. When silver rises, it does two things at once. It signals monetary distrust, and it signals industrial scarcity. That's why governments hate a silver rally. It's a barometer they can't easily explain away, and it's a problem they can't print away. You can print dollars, you can print treasuries, you can print promises, you cannot print metal. So, when the paper price says $90 and the government's own mint is effectively acting like the real price is $173, you're watching a truth leak. A truth leak is how big schemes die. Not with a bang at first, with a drip. A drip that turns into a flood. Now here's the ghost in the exchange. The thing that people don't understand until it's too late. The silver market is built on the assumption that most people won't ask. Most people won't ask for delivery. Most people won't empty the vault. Most people won't demand settlement in metal. So the system sells more claims than it can fulfill. That's the entire business model. It's not evil in a comic book way. It's just leverage. It's how modern markets generate liquidity. But leverage becomes fraud the moment the underlying thing is scarce. If you sell 100 titles to the same house, you're not providing liquidity. You are writing fiction. And fiction survives only while nobody checks the basement. So who checks the basement? The people who need the metal, manufacturers, defense contractors, solar supply chains, battery supply chains, and the new actor people keep ignoring, nations. Sovereigns don't care about your narrative. They don't care about your chart patterns. They don't care about your influence or opinion. They care about stockpiles. They care about strategic materials. They care about what can be blocked, sanctioned, or weaponized. If a nation decides silver is strategic, the retail investor becomes a rounding error, because a sovereign buyer doesn't buy 100 ounces. They buy the market's spare capacity. And when a sovereign buyer enters, the paper price becomes a cartoon. This is why rumors matter even when you can't fully verify them. I've been hearing the same whisper from multiple corners. Quiet accumulation, quiet metal flow, private purchases that don't hit headlines. I'm not here to pretend I have classified intel. I'm here to tell you what the math says if it's even partially true. If a major buyer redirects even a tiny percentage of large capital flows into physical silver, the available pool evaporates. 1%, 0.5%. A rounding error in sovereign terms. And suddenly, 30 million registered ounces looks like a joke. That's why the paper market is terrified of physical premiums, because premiums are the one signal they can't fully crush. They can smash the futures price at 3 a.m. with algorithms and paper dumps. They can trigger stops, shake weak hands, and paint scary candles, but they can't conjure product on dealer shelves. They can't force a mint to sell coins at a loss. They can't make refiners create silver blanks out of thin air. The premium is the heartbeat of reality. And right now, the heartbeat is racing. So what happens next? This is where the story turns from interesting into dangerous. Because the closer we get to March, the more contracts must choose. Roll. Close or deliver. And if delivery stands spike, even a little, the system has to react, not with honesty, with tricks. Here are the tricks I'm watching for, because this is how they buy time. Number 1, emergency margin hikes. Margins are the cash you need to hold a futures position. The exchange can raise them overnight. Official reason, stability. Real reason, force smaller players to sell. If silver starts running and the exchange hikes margins hard, it's a controlled burn. It's them trying to stop a stampede. Number 2, cash settlement pressure. If a contract holder stands for delivery, the system can encourage settlement in cash. They can offer incentives, favorable terms, or just drag their feet until you take the money. Most people will take it. But if enough people refuse cash and want metal, the problem returns bigger. Number 3, narrative warfare. This is the sneakiest weapon. They'll flood the media with stories about bubble top, mania, speculators, retail gamblers, anything to make you feel stupid for holding. They want you to self-censor. They want you to sell before the real move happens. Because the best scam is the one where the victims leave willingly. Now, before we go further, I want you to pause and think, if the paper price is right, and why is the mint charging $173? If the paper market is healthy, why is open interest collapsing? If the supply chain is fine, why do premiums stay elevated even when spot dips? Those 3 questions are the whole story. And if you're still with me, you already get it. This isn't about price, it's about confidence. It's about the integrity of the settlement system. Because a market that cannot deliver is not a market. It's a performance. And the audience is waking up. And don't forget, subscribe to support the original work. And if you're part of the movement against copycats, comment John A.G. Best so I can see you. Now let me lay out my framework because you need a plan, not panic. First, I watch the $90 zone like it's a border wall. Not because $90 is magical, but because it's psychological. Round numbers attract battles. If we see a clean weekly close below $90, not a wick, a real close, that can trigger a deeper paper flush. I'm talking about a move into the low 80s. Would that mean the thesis is dead? No. It would mean the paper game still has enough ammo to force one more shakeout. And paradoxically, that's when physical buyers show up harder, because physical buyers don't care about a 10% dip when they're staring at a multi-year supply problem. Second, I track the gold to silver ratio. This ratio is a pressure gauge. When silver starts leading, the ratio drops. It's a sign of stress in the silver supply chain, not just speculation. A sharp move toward 40.1 would be a giant flare in the sky. Third, I track delivery notices and an intent to deliver signals. When those numbers rise above the sleepy historical baseline, that's when the theater crowd is arriving. That's when the managers stop smiling. And if you want the simplest indicator of all, here it is. Watch the premiums. If spot dips and premiums refuse to fall, the dip is fake. If spot dips and product goes out of stock, the dip is fake. If spot rises and premiums explode, the squeeze has begun. Premiums are the lie detector. Now, I need to address the hard truth nobody likes to say out loud. If this decoupling accelerates, the rules will change. Not later, in real time. Because when a system is built on confidence, the moment confidence breaks, the system will do anything to survive. That includes halts. That includes forced cash settlement. That includes temporary suspensions. That includes rewriting contracts. People think that's impossible because it sounds unfair. Markets are not fair. Markets are functional until they are not. And when survival is on the line, fairness is the first casualty. We watched it in nickel. Now, we watched it in other corners of the derivatives world. And silver has bigger stakes because silver sits under the entire energy transition narrative. Solar needs it. Electronics need it. Defense needs it. And now the world is learning that green is not just policy. It's periodic table math. If silver becomes a strategic bottleneck, governments won't ask politely. They will prioritize industry. They will prioritize national projects. And the public will be the last in line. That's why I keep saying the real risk isn't that silver goes to $120 and you missed it. The real risk is that you try to buy it and you can't, or you can, but only at insane replacement costs. And that's exactly what the Mint is quietly advertising right now. It's a billboard that says, the cheap metal is over. So, is this the biggest Ponzi of all time? Let's frame it correctly. The Ponzi isn't silver. Silver is the flashlight. The Ponzi is the broader debt loop that relies on infinite rolling of obligations. The Ponzi is a system that survives by issuing new promises to cover old promises. The Ponzi is the idea that you can expand claims forever while the underlying reality stays finite. When silver exposes paper leverage, it exposes the same logic that lives in sovereign debt. More claims than assets, more obligations than production, more future promises than present capacity. It's all the same architecture. And silver is one of the few things that reveals it in real time because the metal doesn't negotiate. It either exists or it doesn't. Now we're approaching the part of the story that most people never see coming. Because the biggest moves rarely start with a price spike. They start with a failure to break down. They start with a market that refuses to fall even when the paper crowd disappears. They start with a suspicious floor. That floor is what we're watching right now. Silver is acting like it's being supported, not by speculators, but by necessity, by unseen buying, by physical demand that does not care about the noise. And once that kind of demand locks in, the trade changes. It goes from trading to rationing. And rationing is where prices get violent, because when the last marginal ounce becomes scarce, you don't get gentle candles. You get gaps. You get weekends where the chart reopens at a different planet. You get sudden repricing events that make the past look cheap. That is why I'm not here selling you a fantasy. I'm here to keep you from being gaslit by the screen. The screen is not the economy. The screen is the casino. The physical market is the real story. And the physical market is sending a message so loud you can hear it through the government's own storefront. So here's my bottom line. Silver didn't just move. Silver just exposed. Open interest collapsed, and yet the price held. The Mint priced 1 ounce like it was 2. Premium stayed elevated. Inventory stayed tight. Delivery season is approaching. And the people who write the paper promises look like they're trying to quietly step away before the crowd arrives. That is the ghost in the exchange. That is the phantom event. And if you understand that, you're already ahead of 99% of the market. Because the next phase won't be explained on TV. It will be blamed on speculators. It will be framed as a meme metal. It will be called irrational. But the truth is simpler. A system sold more than it owns, and now reality is knocking. If you want, in the next video, I'll break down the exact signals I'm watching into March, the traps they'll use to shake you out, and the safest ways to stay positioned without getting wrecked by leverage. Until then, keep your head clear, keep your position intentional, and remember this. One last practical check you can do tonight. Call a dealer and ask for size. Not can I buy, but how fast can you ship? Ask about 100-ounce bars. Ask about monster boxes. Watch the delivery estimates. When delivery times stretch while spot pretends to chill quietly, that's the real squeeze starting. Paper can print any number it wants. Metal can only be mined. Take care of yourselves, take care of each other, and I will see you in the next video soon.